In this video, I'm going to talk about the 6 biggest investment mistakes that I see retirees making in their investment portfolios. We're going to identify what those mistakes are. I'm going to talk about my experience seeing these mistakes in action with retirees, and we'll talk about ways that you can avoid these mistakes in your own investment portfolio. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and click the bell icon so that you're alerted when new videos are posted. So let's jump into the mistakes that we see retirees making, and we'll start with the first big mistake, which is investing in the abstract. And what I mean by this is a lot of people own an investment portfolio that they might carry with them to retirement, but they own just sort of a collection of different things. They don't have that investment portfolio or that investment approach tied to any type of financial plan. It's not tied to any type of strategy. We'll call it sort of a rudderless investment plan. And this is really just a symptom of not having an effective retirement plan set up. A retirement plan or a financial plan will tell you the rate of return that you need in order to achieve your retirement income goals. It'll tell you about the asset allocation that will get you to success with the lowest amount of risk that you need to take possible. But the big risk here, the lack of having a plan and owning the assets in the abstract, owning your investments in the abstract, is that you may be tempted to sell those investments at the wrong times. You're going to be more susceptible to making emotional decisions. And we're going to talk about emotional decisions a little bit later in the video. If you don't have that investment portfolio anchored to some sort of a plan, you'll just have a hard time maintaining the discipline to stay the course in difficult times. The second big mistake that I see retirees making with their investments in retirement is over-diversification. And this is a situation where a retiree may start with a portfolio that is very effective, it's low cost, it's diversified, it's risk appropriate for their plan. And then they start to add different sort of satellite positions to that portfolio. They might hear about something from a friend, a neighbor, a colleague, and they might say, hey, I want to add some of that to my investment portfolio. And as that process repeats itself over and over, eventually they end up with this sort of what I call mutual fund salad. Actually, that's a term borrowed from Josh Brown from Ritholtz Wealth Management, and I love it. It's called mutual fund salad. I've seen a lot of these portfolios that come across my desk. They own 15 or 20 different individual mutual funds. And at the end of the day, what they have is not a diversified portfolio, but it's an overlapping set of investments that's likely very inefficient from a fee perspective. There might be gaps in that portfolio. And so eventually, by trying to diversify into all these different things, eventually they just sort of own this blob of nothing as far as it relates to an effective portfolio. And this doesn't just happen with investment portfolios. This also does happen with advisors. And I do see this from time to time. People will come to me and they'll say, I have these investments here, these other investments over here. They might have 3 or 4 different investment advisors. Clients end up with having overlapping portfolios. They have no clear source of advice, and they may have potential gaps, tax issues, etc. So that's the second big mistake that I see retirees making. The third big mistake is called under-diversification. So this is almost the opposite or the exact opposite of over-diversification. This is a portfolio that is invested in too few different types of investments. This can happen when a retiree owns only a small set of individual securities. Possibly they own only a few dividend-paying stocks. They might own a small set of individual sectors or geographies. For example, we'll talk about things like banks or just owning banks, just owning energy stocks in Canada. These are different ways that under-diversification can come up. Often I see that this is a symptom of performance chasing, wanting to chase an investment or a style that has recently gone up. And over the time that I've been reviewing portfolios, it's kind of gone through phases that have followed the different, I won't call them necessarily manias, but followed the different trends through the years. So it started with pot stocks, then it went to cryptocurrencies, and it went to commodities, and gold's gone through that. And now cash is actually sort of the hot asset class that everybody's talking about. So under-diversification is a big problem, and it is a big mistake that I see retirees making in their investment portfolios. The next big mistake is giving into emotions. And really, there's 2 different extremes that giving into your emotions can create issues for you in your retirement investments. The first is at the top of the market. When things are going really, really great, retirees or investors feel like the party's never going to end, that they're invincible. And at the bottom of the market, they feel the exact opposite. They feel like despair and that the risk is at the highest point. And in reality, the situation is exactly the opposite. At the very top of the market, that's where the most danger exists, the most likelihood for a correction towards the downside. And at the bottom of the market is where the most opportunity is, or where potentially risk is the lowest if prices are particularly low or have rapidly dropped over the last short period of time. Now, the trouble with this, it's easy for me to say that, is that we never do know exactly where we are at in that cycle of euphoria and panic, market highs, market lows. We don't know where we are until we can look backwards. And so this is a really tricky one. This is one that I do see people destroying a lot of wealth by giving into their emotions at the top of the market or at the bottom of the market. And I think of all the investment mistakes, I think this is probably the most dangerous one, due to the 24/7 news cycle that all investors, especially retirees, people that are really focused on their investments in that period right before, right after retirement, they're most susceptible to, is just that constant siren from the financial news media, just sort of giving them bad news all the time. The next big investment mistake is chasing yield. So this is when investors will strictly pay attention to the current yield of their investments and completely disregard everything else. This happens with investors who are particularly focused on owning dividend-paying stocks in their portfolios, maybe real estate investment trusts or high-yield bonds. The only property of that investment that they care about is the current yield of that investment. But the reminder that I like to give in this situation or these situation is that risk and return can never be separated. So if there is an investment out there that's offering you a high yield, you are being asked, or you're being demanded to retain or to take on some sort of risk in that investment, whether you see it or not. The person offering or selling that investment that's yielding 6, 7, 8, 9% per year, when safe securities like government bonds are yielding 3, 4% per year, the person offering that higher yield investment is not doing that out of the goodness of their heart. They're doing that because there's some risk in that investment that they no longer want to retain, and they're trying to offload that by selling it to you. So whether or not you see that risk or you're willing to acknowledge that risk does exist with high yield investments, and strictly focusing on the yield of an investment is not really a great way to evaluate whether or not it should be added in your portfolio. And then the final big mistake that I'll talk about is what's called anchoring to cost basis. So this is a situation where you may purchase an investment at some point and it drops in value, and you look at it and say, I'm only holding on to it until I break even. I'm only holding on to it because I want it to get back to what I paid for it, because I can't emotionally take the idea of taking the loss, acknowledging that I may have made a mistake. I do see this happen often with people that may have purchased either an individual security or a particular investment, and they feel a lot of regret, and they're saying, look, I know I need to get out of this, but I'm going to hold on until it breaks even. And the quote from Nick Murray here is that your investments don't know how much you paid for them, and they wouldn't behave any differently if they did. I absolutely love that quote. Another very dangerous form of anchoring on cost basis is avoiding selling a position in your portfolio and re-diversifying just to avoid the tax bill. And I have seen this come from time to time. Somebody owns an individual stock that's gone way up in value. I suggest to them you should diversify away from this because it's no longer appropriate to hold so much of your wealth in one security. And the reason that they may resist that advice is because they don't want to take the tax bill. Now, the reality is that something very good has happened. They've created some wealth in an individual position, but it's no longer appropriate for them as they enter retirement. They know that they should diversify away from it, but they don't want to take that tax hit. Now let's think that through. So the only way to avoid the tax hit on this is if the security goes way down in value. And they could effectively eliminate that possibility. If that stock goes way down below their cost basis, they wouldn't have any tax bill to pay, but then they also would not have profited from owning that individual position. So sometimes I see people getting a little bit mixed up with this. It's very difficult emotionally to say, I'm going to take the tax hit, I'm going to sell this position, but it is often the most prudent thing to do when we're thinking about approaching retirement and holding investments as we enter retirement that are appropriate for our plan. And that's all I had for biggest investment mistakes. Now we'll go back to our agenda and we'll look at how far we've come in our series. Today we talked about the big investment mistakes, and we're going to finish our series next week talking about some advanced strategies. I hope that you enjoyed this video. If you like it, give it a thumbs up. Leave me any questions or comments below. Thanks for watching, and I'll speak with you soon. Take care.